Ratio analysis. So ratio analysis is a comparison, generally speaking, of good things to required things. So, for example, we might want sales and consider sales to be good, and we might think about inventory as a way we achieve sales. And so something we could do mathematically is take sales divided by inventory. But what would that do? Well, that would tell us that every dollar of inventory generated some amount of dollars of sales. If that number is small, then our inventory is going to be a significant expense for our firm. If that number is large, then inventory won't be as expensive. But we could really put just about anything in either place. Or we could have net income in the top and inventory in the bottom, or we could put assets in the bottom or equity on the bottom. All these things are in some sense required, or we need assets to make the firm do its thing. But maybe needing less assets to make more money is better than needing more assets. And so a lot of the ratios we'll think about will take on this general form, and often it will be an income sheet item over a balance sheet item, but not always. So for example, we might consider the ratio of current assets to current liabilities. Those are both balance sheet items, but that's an important ratio in that it tells us how available funds are to pay the short-term financial responsibilities of the firm. So there's exceptions, but often we're looking at an income sheet item over a balance sheet item. And we're often doing division, but not always. So in fact, in the first example we'll do, it will be a subtraction rather than division, but division is the more usual case. So there are different things we can measure. For the first category, though, that we'll look at is performance measures. So performance measure how well the firm is doing overall. So obviously one performance measure is net income. So net income tells us the dollar value generated by the firm in that year, and that's a performance measure that gets used. And the problem with net income as a performance measure is it doesn't necessarily take into account how much was required to earn that net income. Right? If I take $1 and turn it into $1 million of net income, that's amazing. And if I take $1 billion and turn it into $1 million of net income, that's a pretty terrible interest rate. So it does really matter what was required to earn net income. And so one way to take that into account is a quantity called economic value added. And the idea of economic value added is to track in dollars how much value was added to investors this year. And that's important because investors have other things they can do with their money, right? They could have invested in a different company. So if you are not providing enough income to the investors to justify them giving you their investment funds, then you're not actually generating economic value. So for example, a company like Federal Express has been profitable for a very long time, but has also attracted significant investment funds for planes and trucks and everything. And so if you actually look at the total economic value generated by Federal Express, it's basically zero. So yes, Federal Express made lots of money, but given what was required to create Federal Express, it could have just been not done, and investors would have invested in similar risk investments and had a similar return. Whereas UPS actually would have significantly higher value than the invested funds required. And so different companies will have different values for these things. So economic value added has a definition, and you'll see this pattern consistently when we think about ratios. Is we have a mathematical definition for what it is, and then some simple arithmetic to calculate it. So in economic value added, we are looking at interest plus earnings, again because interest is a finance expense rather than an operating expense, and it counts as paying an investor, and we're paying an investor when we pay interest. So I have interest plus net income, and then we're going to subtract cost of capital times capital. And why we do that is because the capital costs are, well, that's what the investors require. The investors require some a return on their capital investment, and so then we can ask the question: are the earnings created greater than the dollars of required return that the capital holders would request? Just a second, and get a drink here. So if we look at Techne as an example, so Techne has an 11% cost of capital, according to their investor materials. So an 11% cost means we can look at the total capital of Techne, which is the equity, the value of stockholders' equity plus the value of debt. Now, Techne doesn't have any debt, at least the long-term kind. So if we go back up to the Techne sheets here, you can see down in that first 2011 balance sheet column, all the way at the bottom, there's a total shareholders' equity number of $586,122. So there's $586 million of equity contributed by the shareholders. Now, in the case of Techne, it's mostly retained earnings. So the company made some profits, and instead of giving it back to the investors, they kept it to make the firm bigger. So it's tempting to think that money is free, but it actually has an opportunity cost. So there's no dollars directly to keeping money in the firm. But investors could have received the money and reinvested it in a different company and earned money in a different company. So any money that's kept has an expectation that it will pay returns. And so we have $586 million tied up in Techne. It better be paying us some money. So for Techne, we take that $586 million and multiply by the 11% required return. And you can see, right, we'd get a little bit bigger than $60 million of expected payments to stockholders by Techne. Since we actually have $112 million, that's a significant positive difference. So this is a company that takes capital and uses it to produce more value than you would expect given the risk level. And those are attractive companies to be investors in, right? Because you get a higher return than your risk would indicate. Now, the stock market is a public market whose prices adjust. So what that means is that stock of Techne Corp would trade for significantly more than the assets of the firm itself would indicate, right? We've got $500 million of retained earnings, or almost $600 million of contributed capital and retained earnings, but the market value of Techne is likely significantly higher than that. So we can try this with Techne, which we just did. So let's do a different one. Let's try it for Google. So we need first net income. Right, so if we look at our definition, we have, in fact, let's copy this here. Let's copy this definition, and we'll move it over to Excel. So here's our definition. Oh, make that a little smaller. Okay, so we need net income for Google. So I'll go back here. Oh, let's go check it out here. Google, there we go. So Google, here's their income statement. We have 9737 of net income. 9737, right? So that's 9 billion, I believe, right? Yep, in millions. So they have $9 billion in net income. And let's see what we have for now. Here's the total assets of Google, And then down here, they do have a small amount of long-term debt. Because they have long-term debt, maybe we ought to pay attention to interest, see if they break interest out. It looks like they actually have positive interest. So even though they do have debt, they have more interest paying securities than they have interest charging securities. Technically, I suppose we should put that in as a negative then, right? Because we didn't pay anything, we negative paid it. So that, I mean, Google's a little bit different that way. So 584, get negative 584, making the total payments available to our investors 9153. And then we need the capital and cost of capital. So capital is that balance sheet number for Google in the equity column. So we have we have total liabilities. So we need to add these up, right? So here's all the liabilities. So here's total current liabilities, and then we can add up these other things here. So let's just copy this, because we need to get to an equity number. We'll see. All right, so let's add these up. So I'm using the sum function. So we got $14 billion in liabilities, and our total assets are $72.5 billion. Okay, so this is liabilities. Oh, move that over here. So this is equity. Nope, assets. And so, since balance sheets have to balance, right? We know that the liabilities and equity section has to equal the assets. And so if we subtract liabilities from assets, we get an equity value of this. Okay, so here is our equity value. And we don't have a cost of capital for Google. So this would be something that you would look up. It's either given information of the problem, or you could use the firm's beta for this. We'll talk about that at the end of this quarter. Just for the sake of doing this problem, we will use the Techni cost of capital of 11%, since they probably have fairly similar risk levels, being intellectual properties firms that are growing. So I have my net income plus after-tax interest paid, and then I'll subtract, right? So I'm just following the definition here. Value minus capital times cost of capital. And so we get Google generating just a little under $3 billion of economic value. And I think that's probably not a huge surprise, right? We might have a feeling that Google is more than the sum of its parts, that it's generating something beyond what you'd expect given the capital contributed to it. Economic value added is the most complicated quantity in this half of week one. The rest of them are much simpler. So just as an example, here we have market to book. So this is the market value of equity to book value of equity. Book value of equity we just calculated. So for Google, it would be that $58 billion. So if we knew the market value of Google, we'd do the 1 divided by the other and get a ratio. If that number is bigger than 1, it suggests that the firm is worth more than the things that are in the firm, and that indicates a history of generating economic value, right? If we have a history of destroying economic value by not returning enough money to our investors, then the value to the investors of the firm will be in aggregate less than the value of the capital that has been contributed over the history of the firm. So market to book is a measure of growth options. It's a measure of the history of the quality of management and the history of the firm. So it gets used for lots of things, and it's a measure of potentially intangible assets, right? Higher intangible assets would mean more market value because the intangible assets have value, but they don't necessarily have accurate value in the accounting. Okay, so let's take a look at some metrics here. So performance metrics tend to focus on net income because that's a measure of how well the firm has done this year. And so naturally, if we have net income in the numerator, there are lots of things we can put in the denominator. So return on capital is net income divided by capital. So it's dollars per dollar of capital invested. So this would be naturally then in percentage terms. Right now for Techne, return on capital and return on equity are going to look very similar because they only have equity capital. But for other firms, that might be different. And this is actually, right, we know this, it's after-tax interest. There we go. Just like before. Return on equity is a very common measure. That is net income divided by equity. So we're asking how much value did I generate per dollar of equity invested in the firm. This is a really common metric used for CEO compensation measures. So if I think about accounting-based compensation, this is probably what I'm talking about. Was ROE good this year? So we can think about earnings per dollar of equity, earnings per dollar of assets, that's return on assets. Earning per dollar of sales is operating profit margin. Notice these are two income statement items. That does happen sometimes, occasionally. Usually it's income over balance sheet, but not always. And so we can ask, what do we get for Techne? So I want you to go ahead and try it. So I've got the balance sheet and the income statement available in the slides here. So go ahead and give it a shot, and when you come back, we can look at the answers to those ratio calculations. Okay, so if you've done it correctly, you'll get something like this. So clearly, right, Techne has some pretty incredible numbers, especially looking at operating profit margin. They're at a 40% profit margin. That's and that often when we think about gross margin, right, that's just value sales minus variable costs, and 40% gross margin is pretty good, right? So a 40% profit margin is really, really good. So Techne is a very profitable company. But those are the kind of things that a performance metric, ratio measure can tell you. So that's the broad category of performance measures. Efficiency measures are a different category. These are less focused on overall performance of the firm for the year and more focused on how well are we using some particular asset. So for example, we can think about assets turning into income, which is return on assets, but we can also think about assets turning into sales. Now obviously if we're selling at a loss, this is bad, but independently, you might be interested in how well we're turning our assets to sales. And so that is a ratio that's used. It's called the total asset turnover. But there are lots of efficiency ratios like this, where we're looking at generally income to balance sheet items, but not necessarily net income itself. So asset turnover, I'd mentioned, sales to assets. We also have inventory turnover, which is the total dollar value for the year spent on buying inventory divided by the inventory on hand at the time of the snapshot. So if you think about If I have $10 million of inventory and $100 million spent on inventory, that means over the course of the year, I sold through my inventory 10 times. And generally selling through the inventory more is better because it means we have less sitting on shelves, we have less money tied up in the business and less that could maybe go bad or become out of date. And this ratio has two forms, right? We can get the one way is to say 10, right? So we go through it 10 times. The other way is to flip that upside down, and it would be 1/10, but then multiply by 365 to get days, right? So that would be the typical widget in inventory sits on the shelf on average 36.5 days. We have a similar kind of ratio for receivables. So accounts receivable are people, customers owe us money. They haven't paid us yet, but they will, hopefully. And this is really common in a lot of industries that we have to offer credit to our customers to help them with their cash flow so that they can afford to buy from us. Different industries have different credit policies on average. And so we can think about how well are we using our receivables to turn into sales. For a company like Walmart, this is incredibly good because they sell almost nothing on credit, whereas in something like a hospital, you might have, this number might be 2 instead of 100, right? I mean, medical billing takes forever. So they have lots and lots and lots of receivables, and hospitals invest a lot of energy thinking about speeding up their receivable cycle because it turns into lots of cash showing up when they can do it. So again, we'll ask, what are these for Techne? So go ahead and give it a try, and I'll give you the answers after the pause. Okay, there you go. So obviously some of these are better than others. A total asset turnover of 46% is pretty bad, right? Usually we would like that to be much higher than that. But again, these depend on the nature of the industry, right? So for Techne, their total asset turnover is really bad. Average days in inventory is really bad. Collection period is okay compared to companies not in their industry. But so for Techne, right, these are some areas of concern, you would think, but with profits being so high, it probably, it's because that's what you worry about with having a long inventory turnover cycle, is that the products are becoming obsolete or not being used, so that we have wastage. But what's probably happening for Techne is that they have, the profits are so high on each sale, it doesn't make sense to worry about. You don't want to risk stocking out on things, and also maybe it takes a long time to convert from production to sale. So we'd have to get further into their business to understand whether this is really a problem or not. But a naive look would be concerning, right? 252 days in inventory is a long time, typically. Another kind of analysis is DuPont analysis. It's kind of a combination of performance and efficiency, and it kind of comes from a little game we can play with fractions. So let me show you how this works. So if we go to, right, so if I take ROE, right, ROE is net income divided by equity, right, and we'll put a line there, right, and right here, so equals, and I'll merge these cells if I can. Let's see, yeah, center that guy. Okay, there we go. So we've got net income divided by equity, and we might as well center that too. Just go crazy. There we go. Okay. So I have net income over equity. And what I'm going to do, right, is that's the same thing as net income over equity. But certainly I can multiply by sales over sales, right? That's just like multiplying by the number 1. Right, so I'm doing math here, right? So net income over equity equals net income over equity times sales over sales. Well, when you multiply fractions, right, it's just numerator times numerator over denominator times denominator. And if you remember the associative property from your math class a million years ago, we can just we can multiply in whatever order we want. So we're going to do this order. If you see what we've done, right, now I have net income over sales times sales over equity. And if we multiply these fractions, right, of course what you would do is just cancel the sales, right, and just get net income over equity. So we have equality here. But I'm going to play this game again. Play this game again with assets. Make it nice and centered. And now you might be beginning to get a flavor for what we're doing. Because these are all named. Well, these two at least are named, and this one's about to be. Right, so this is return on equity. So return on equity is equal to, that's how you do that, put a little apostrophe in front. Return on equity is equal to profit margin plus total asset turnover. And we call this the equity multiplier. Profit margin times total asset turnover times equity multiplier. So what does that mean? So if we want our equity to pay us money, that is a function or a combination of profits per sale, sales per asset, and assets per dollar of equity. Right? And if we're good at all of these things, we'll be really good at this. And often we can think about companies just being really good at one of these things. So if you look at Techni, are they good at, right, for every dollar of equity, do they get lots of assets? No. In fact, this Techni, it's dollar for dollar. They don't have any debt. So this is not helping for Techni. Sales to assets, do they have good, a good turnover? No, they don't. It's not very good at all, in fact. So this is bad and this is bad. So how does Techni get a good ROE? Right, they have a ridiculously high profit margin. Right? If I'm Walmart, right, does Walmart have a high profit margin? Not really. Do they have high sales to assets? Absolutely. Right? This is the secret of Walmart. They just churn through stuff like crazy. Right? So you can be profitable by being good at one or more of these things, of these individual quantities. And that's kind of the discovery of DuPont analysis, is that the total performance of the firm is composed of several different subcategories of performance. And so we can do this for each of these. And so, we know for Techni, we had a profit margin of, it was 38%, something like that, right? And then total asset turnover was something like 46%, and the equity multiplier is just going to be 100% because they don't have any debt. So if we multiply those things together, we can get an estimate of the return on equity for Techni of 17, and their cost of capital was 11. So now we can see how Techni ends up being an economic value added company, and that their return to their shareholders is greater than the return their shareholders expect. Right? But this is happening because the profit margin is good, not because total asset turnover is like 10. Right? So if Techni could have the margins they have and sell like Walmart, right, they would be a much better, right, it would be ridiculous, right? But of course, this is not how life works. You can't be Walmart and have huge profit margins. The last category of ratios are liquidity ratios. So we have current ratio, quick ratio, and cash ratio. I'll get back to these in the next part, and then we'll finish up for the week.